Today we're going to have an update on the current housing market and what it's doing. In my last video, of course, we talked about the fact that the housing situation might be in a bubble. Housing prices were going up so rapidly that it was pricing a lot of people out of the market. The supply couldn't keep up with demand. There were multiple bidders on significant numbers of properties. And because of that, the prices were just increasing at a very rapid rate. So what I want to do is pop up a series of data points here just to show what has been happening in the market and what we might be able to expect. What I have on the screen right now is an article from Fortune magazine that came out a couple days ago. And I thought it was particularly instructive because it told basically the story. The pandemic housing boom, which is what we've been part of the last couple of years, has increased prices of homes about 34.5%. This increase, of course, has been very difficult for a lot of people to handle. Some people just not even trying to compete in the market. But the biggest challenge has been the fact that prices have been rising so fast. A couple things contributed to that. There was a lot of money in the market, meaning the Federal Reserve and the federal government were, in their CARES Act and so forth, were sending checks to families. At the same time, the Federal Reserve was making interest rates extremely low. So it was easy to afford a mortgage, and therefore, with the low percentage rates, you can afford a higher priced home. Well, that means that there's more buyers in the market. It creates more demand when there's more buyers in the market. So the situation was kind of a perfect storm that literally happened. A lot of money in the market. People had money to invest in new homes. People who weren't in homes before could take some of that money they were receiving in checks from the government if their employment stayed the same and they weren't impacted so much by the COVID virus in their particular business. In other words, they weren't laid off or unemployed. They could invest that money rather than just keep it or use it for expenses. So that created a situation where people had money to spend, they had money to put on down payments, there were low mortgage rates, and it created a housing boom. So what we see now, though, is the expiration of the CARES Act. We see checks not going out to people anymore. We are starting to see the Federal Reserve react to the fact that there was so much money in the marketplace that they need to now cool the inflationary cycle that's been created by that. And in order to cool the inflationary cycle, one of the targets is to cool the mortgage situation. In other words, cool the housing market. And so what I'm going to show you is the data is showing that the housing market is in fact cooling. So if we look at, for example, housing starts. Now, housing starts are not softening nearly as fast. In other words, builders are out there still building houses because there still is good demand. In fact, at this point, there's still more demand than there is houses that people want to buy. And so you've got a situation where the new housing starts are staying fairly level. Well, that's actually good, and you'll see that start to bear out in the statistics at the end. But now new home sales are slowing down fairly dramatically from a high in January of 813 million homes to 591 million homes. A very, very quick drop in the number of homes that are new homes that are being sold. Existing home sales have about the same data, from 6,490 million to 5,610 million. So you've got a situation where the houses are not being bought as quickly as possible. Now, the Fortune magazine article is making the case that home prices are going to decelerate. In other words, instead of leaping forward 10-20% per year, they're going to continue to move forward 1 to 2 to 3, whatever percentage rate, but a percentage rate less of an increase than they did before. My previous video said that basically the Federal Reserve said that the housing market was unhinged from fundamentals. Well, being unhinged from fundamentals tells me that there has to be an adjustment to the price of houses, that prices of houses have to become more in a reality with what people can afford. And right now, the affordability factor for houses is really quite difficult. People are struggling to afford the ramped up prices. 34%, houses are a third higher price today. So if you're in the market for a $300,000 house, that means that $300,000 house now costs $400,000 today. And that's a big pill to swallow. Add $100,000 to your mortgage, or if you're paying a 20% down, you're adding $80,000 of that to your mortgage. You're going to pay a substantial amount more, even if the interest rates are low. Now with the interest rates increasing, I don't think that it's going to just slow. I have a feeling that prices are going to soften, but we'll give you an update as we start seeing that data come in. Right now, when it talks about housing here, the median price for all housing types is $391,000, up 14% still from April of last year. So while it's slowing, it's still increasing. We'll continue to watch these figures and see what that median house price is doing, because wages are not going up that fast. Inflation is taking more of that paycheck away from people. If your wages are not increasing as fast as the housing, and more of your budget is being placed in essential goods and services, then you're going to have less money to spend on that mortgage, and it becomes less and less affordable if those prices continue to go up. So existing home inventory, this is the number that the Fed is really focused on. The inventory is going up. When the inventory goes up, a greater supply, and if you know about those supply and demand curves, as supply goes up, it starts meeting that demand curve. And when the supply exceeds the amount of demand, that's when we start seeing the prices begin to soften and not increase as fast as Fortune would say, or possibly dip a bit, as I would say going forward. So here's what's happening in the market at this point in April of 2022. Next month, we'll put out another video and let you know what's happened the next month and see what is transpiring. If you're wanting to buy a house at this point, I'm sitting on the sidelines. I would like to buy our next house, but I'm sitting on the sidelines kind of waiting for something to happen. Hopefully interest rates don't get too overly large and prices do soften, and we'll be able to afford a place better 6 months from now than we could today. So thanks for joining. Hope you join me for the next video, and please hit the subscribe button so we can grow the channel and reach more people. Thank you much. Bye-bye.